So as an intended finance major at University of Georgia, I'm going to give you guys a bit of insight on what I have been studying as someone who's never taken any type of thing like this. This is some things that I've heard are pretty important to know from my principles of accounting class. First of all, we're going to start off with the balance sheet, statement of cash flows, and income statement. Say, look at balance sheet as like a literal picture of how your business is doing. Let's say hypothetically today, I want to look at how my business is doing today. I will take what I have as assets. I'll take what I have as liabilities. I'll take my stockholders' equity, and I would also look at my retained earnings. All of these would be on my balance sheet because all of that information is going to tell me how my business is doing at this very moment. So now let's get into the assets, liabilities, all of that. What even is that, right? Assets is what you own. Let's say hypothetically like this stylus, right? I own this because I bought it and I paid it off. I don't owe money to anyone. This is like 100% mine. Like, I own it. If hypothetically I were to, let's say I got this for like $1 and I promised to pay the rest off at a later date, this wouldn't be 100% mine anymore because I'm still owing someone. So in accounting, if you still owe money, it's not yours yet, and it's actually a liability. And you could think that as a liability because technically what a liability is something that can possibly harm you in the end. It's not, you can't rely on it. You can't rely on your liability, right? You're not sure if you're gonna have the money to pay this off. Let's say this was like $20 and I don't know if I'm gonna have the money in time to pay this off, right? That's why it's a liability. So liabilities is not what you own yet. You still are paying it off. Assets is what you 100% own. Now let's look at stockholders' equity. Equity is when you have like a share in a company. Stocks that you have in a company. Equity is the shares that you have in a company. And that all stems from the two different types of financing that you talk about in accounting 1. There's debt financing, where you have to go into debt in order to get funding for your business. Think of financing as funding. You're asking a rich person to fund your business, and you promise to pay them back later. So you go into debt because you're having to owe money. But you could also go another route. That's going to be your equity financing, where instead of promising to pay them back later, you're just promising to give them a part of your company. So that equity is just a part of your company that you're giving to other people. That those pieces, that's stockholders' equity. The stockholder, they're holding that stock, right? And then the equity is just the part of the company that they have. That's at least how I think of it. I've only taken this class for a week. Those are some things that I've gathered. So correct me if I'm wrong on anything or could explain anything better.